loss, and 2, long-term assets which can be used to cover the 2 months' payments required for reserves. To verify the borrower's assets, you can use bank statements, investment statements, and verification of deposits. Down payment options. Cash cannot be used unless it is deposited into an account and has at least 60 days seasoning. Verified deposits in checking accounts and savings accounts are most often used for down payments. An additional down payment option would be a gift from a blood relative or significant other and a letter that shows no requirement for repayment. There are also down payment assistance programs that assist first-time homebuyers. The assistance could come from city, county, or state programs. Income. There are 2 types of income, stable income and variable income. The income is verified with 1099s, W-2s, pay stubs, tax returns with a 4506T as required, and a verification of employment. 2-year history is required to provide continuity of income. Non-taxable income can be grossed up by 25%. An example of non-taxable income would be Social Security benefits. A borrower is considered self-employed if they own 25% or more of a company. There's a lot of additional analysis for self-employed borrowers to ensure continuity of income. There are 6 income calculations that are essential to know when we are talking about calculating income. If the borrower is paid annually, the calculation is annual gross income divided by 12 months. If the borrower is paid monthly, there is no calculation. If the borrower is paid twice monthly, for example, they are paid on the 5th and the 25th of the month, the calculation is the amount of each paycheck times 2 pay periods. If the borrower is paid biweekly, the calculation is biweekly gross pay times 26 periods in a year divided by 12 months. If the borrower is paid weekly, the calculation is weekly gross pay times 52 pay periods divided by 12 months. If the borrower is paid hourly, the calculation is hourly gross pay times average number of hours worked per week times 52 weeks divided by 12 months. Liabilities. All liabilities must be disclosed by the borrower if they are not on the credit report. Any payment on liabilities that has less than 10 payments left does not have to be included in the ratios. The exception is a leased vehicle. Payments that are not considered liabilities include things like utilities and cell phone payments. Ratios. When calculating ratios, the front end or housing ratio and the back end or overall ratio are used. Each of the agency products all have different ratios to qualify the loan. Conventional ratios are 28% front end and 36% back end. FHA ratios are 31% front end, 43% back end. VA has a back-end DTI of 41% with residual income calculation. USDA ratios are 29% front-end, 41% back-end. Loan-to-value. Loan-to-value is considered a qualifying ratio. The maximum LTV, or loan-to-value, on the programs we discussed are conventional, 97%, or a 3% down payment. FHA, 96.5% with a 3.5% down payment. VA, 100%, no down payment is required. And USDA, 100% with no down payment required. Credit report. The credit report that is pulled for underwriting a loan is called the tri-merge, the merging of the 3 credit agencies. Experian, TransUnion, and Equifax. The underwriter will use the middle credit score when underwriting. Credit scores range from 300 to 850. Bankruptcy show on the credit report for 7 years on a Chapter 11 or Chapter 13 and 10 years on a Chapter 7. For a conventional loan, if a borrower's credit report shows that a borrower has been 60 or more days late within the past 12 months, the underwriter will deny the loan unless there are extenuating circumstances. Also, for a conventional loan, a borrower is prohibited from obtaining a loan if they have had a foreclosure reported on their credit within the previous 7 years.